So this is Gene Trowbridge, and welcome to our YouTube channel, Trowbridge and Nay. Today we're going to talk about the passive loss rules. And understanding the passive loss rule seems like a big deal, but it really isn't. It's relatively simple. I've got, 7 bullet points here that I'm going to go through quickly, and then I'm going to give you a simple example. The passive loss rule starts with the fact that the IRS has defined 2 types of income, passive and active. And if you want a simple definition, your active income would be your W-2 income. That would be a good one. Or for me, I'm active in the management of my law firm. I get a K-1 at the end of the year. So that's active income to me. But passive income would be something that I've invested in that I don't have a day-to-day responsibility over. And interestingly enough, when this law came out in 1986, the IRS defined rental real estate as a passive activity. Obviously, they've never tried to run their own property and deal with tenants and toilets and trash. But anyhow, it is by definition a passive activity. So the IRS defines investing in an LLC as a passive activity. If you're a member of an LLC, that's a passive activity. So we've got a double whammy. We've got rental real estate as passive, and investing in rental real estate as a member in an LLC is also passive. So what does the rule say? The rule says that losses from passive activities may only offset income from passive activities. So I use the analogy of a basket. There's a passive activity basket, there's an active income basket, and all your passive income and passive losses go in the passive basket. And in that basket, the next bullet point says that losses from passive activities can't offset the income that's in your active basket. And if you can't use those losses today, they're going to be suspended until the future. And then suspended losses from passive activities can be used in the future to offset income from passive activities. So the first thing to know visually is there's this passive basket. If all you're putting in there is passive income, well, you're going to pay taxes on that. If all you're putting in there is passive losses, they're all going to be suspended. If you're putting some of both in there, passive income and passive losses, they'll offset each other. But whenever there's more passive loss than there is passive income, the passive loss will be suspended. Now, this can be quite complicated. I know quite a few investors who have 10, 20, or more LLCs that they've invested in. So all the activities of all the LLCs go into the passive basket, and then it's up to the CPA to figure out what the rules are. Certainly the taxpayer wouldn't understand that. But suffice it to say, if there's more passive loss in that basket than there is passive income, then that passive loss will be suspended until the future. So let's look at a simple example. Here's a rental property. NOI is $1 million. Interest payments are $600 this year, and $600,000 of all the depreciation you take. So tax-wise, this property has lost $200,000. And the question is, can you use that loss? Well, the passive loss rule says passive losses cannot offset active income. So we have to look to see what we can do with that $200,000. Now, same property, but we have the situation where an individual owner owns that property and does all the work and qualifies as a real estate investor. So the individual owner from their W-2 has $300,000. they have passive income from other sources, okay, of 200,000. They have passive losses from this property of 200,000. So what's the rule? Passive losses can offset passive income. So in this case, the passive losses offset the passive income, and the only thing the taxpayer will be taxed on or has to report is the $300,000. Remember, rental real estate is defined as passive, so the losses go in the passive basket. But there must be some other activity the investor has. Maybe it's another piece of rental income that's producing $200,000 of passive income. So now they're both in the passive basket at the end of the year, and they offset each other. And that's great tax shelter, right? The 200,000 has sheltered the $200,000 of passive income. That's a simple example of how it would work for an individual owner. Now, let's say it's another individual owner, but the situation is a little different. This individual owner owns the property with a $200,000 loss this year. And then when they go to do their taxes, the CPA says, we've got $300,000 from your W-2 income that's active. You have $200,000 in your passive basket, but there's no income in your passive basket. So the passive loss rule says you can't take the 200 out of your passive basket to shelter the 300 in your active basket. So if you can't use it, what is it? It's suspended. So in this situation, the investor pays taxes or reports $300,000 based on their W-2 or their active income and has $200,000 of suspended losses. Remember, passive losses can only be used when there's passive income. But that doesn't mean they're lost forever. The term is that they're suspended. So this taxpayer will have $200,000 sitting in their passive basket waiting for some passive income to go in there, which will eat up those suspended losses. Now here's a investor in an LLC, same property, $200,000 of taxable loss this year. This 25% LLC investor has in his world or her world active income of $300,000 from W-2. Here comes the K-1 that says you have a passive loss this year. Your 25% ownership of the $200,000 taxable loss gives you $50,000 in your passive basket. But you have no other income in your passive basket. So this year, you're going to report the $300,000 of your W-2 income and pay taxes on that. And have $50,000 of suspended losses in this passive basket to carry over until next year. And so here are some of the rules. On operations, suspended losses can be used against future passive income. Okay, so let's say in this case that you have $200,000 of suspended losses in your basket. And this year, the property produces $50,000 of passive income. So you had 200 in your basket, 50,000 now, this year is income, and they offset each other. So you have no income to report from the passive activities, but you still have $150,000 of suspended losses carried forward. So on the sale, suspended losses can be used against future passive income. So let's just say the passive income from the sale of this property is $500,000. Where does that go? It goes into the passive basket. And what's in the passive basket? is $150,000 of suspended losses. Remember, suspended losses can offset passive income. So we have 500,000 of passive income, 150,000 of passive suspended losses. So the 150 will shelter a portion of the passive income from sale, and you would have $350,000 to report as passive income that you're going to have to report and pay taxes on. Now, so this works the same way. If you're an investor in an LLC, you're going to get a share of the suspended losses. You're going to get a share of the passive income the next year. On the sale, you're going to get a share of the passive income from the sale, and you're going to have suspended losses. So it all works the same. It's just think of the basket approach. There's a passive basket, and all the passive losses and income go in there first and see if they can offset one another. If there's passive income as a result of the year, you report it. If it's a passive loss as a result of the activities for a year, they are suspended. But it usually all works out at the sale. At the sale, there's usually more income, sale price minus basis minus cost is passive income. The passive income goes into the passive basket and looks for suspended losses to offset the income. Now, where it gets complicated is, once again, if I'm talking to someone who has 20 or 30 LLC investments, and all sorts of things are happening during the year. Well, that's for the accountant to figure out exactly what's happening in their passive basket, and the accountant has a form that's done on, and they keep all the records, so the accountant can do all that. Just remember, in a total situation, all passive income goes into the passive basket. All passive losses go into the passive basket, and in that basket, they offset each other, and they come up either with the result of you have more income than losses and you report some, or you have more losses than income, and they're suspended until future years. So what's the bottom line? You may run into a situation as a passive investor in your LLC that the losses created this year won't be available to you for your CPA to use on your current tax return. You thought they might be, but we've got cost segregation, we've got bonus depreciation, it's pretty exciting. They won't be available currently, but eventually they all will be available. And typically it works out when passive income from other activities goes in the basket, or if you only have one thing, when there's a sale, the gain from the sale goes in the basket, and the passive losses are used. All losses are used. It's just that they may not be used currently. So this is Gene Trowbridge with the law firm of Trowbridge & Ney talking about passive losses, and isn't this tax stuff fun? So if you have any questions about your syndications, or if you are a syndicator and you're looking for a law firm to represent you, contact us. Here's our phone number, 949-570-1507, 949-570-1507. And then there's our website, tnllp.com. And we'll look forward to hearing from you. Thank you.